Let's calculate a company's free cash flow. Free cash flow measures how much cash a company has left after paying for all operating and capital expenses. Provided for us, we have information for St. Patrick's Company. Here we have operating income. We have depreciation and amortization, changes in working capital, capital expenditures, and tax rates. Now let's go one by one explaining what each of these are. Operating income, or earnings before interest and taxes, essentially shows how much money the company made from its regular core operations without considering financial costs such as interest on debt and taxes. This helps us understand how well the company is performing. For our example, we have 7 million as our operating income or interest or earnings before interest and taxes. Moving on to depreciation and amortization. Depreciation refers to the reduction in value of physical assets. Examples would be machinery, equipment, or buildings. Amortization is similar, but for intangible assets. Examples would be copyrights or patents. This tells us the gradual loss of value over time. For our example, we have $130,000 in depreciation and amortization. Let's go ahead to changes in working capital. It is the difference between a company's current assets and current liabilities, and it shows the company's short-term liquidity. Essentially, whether we have enough assets to fulfill our obligations with our liabilities. And for our example here, we have $100,000 as our number for changes in working capital. Capital expenditures are investments a company makes in long-term assets. For example, buying a new factory or upgrading equipment. This indicates how much the company is investing in its future growth and ability to generate revenue. Our number for capital expenditures is $1 million. We're going to be working using $1 million in this example. Now moving on to, last but not least, tax rate. Tax rate is the percentage of a company's profits that must be paid in cash, must be paid in taxes to the government. It is important for assessing the company's financial health because higher tax rates would mean a company would have to pay more in taxes, leaving less cash available for operations, reinvestments, or shareholders' returns. For our example, we have a tax rate of 24%. Now let's go ahead and move to our solution. This is the equation to solve for free cash flow, which equals earnings before interest and taxes times 1 minus tax return, then adding back depreciation and amortization, subtracting changes in working capital, and finally subtracting capital expenditure. Let's go ahead step by step using this information right here. We're going to solve for St. Patrick's free cash flow. Step 1 is earning before interest and taxes after tax rate. We would take the $7 million and multiply that by 1 minus the tax rate, which is 24%. This equals 7 million times 0.76, which gives us a total of $5,320,000. Let's move ahead to step number 2, which is to add depreciation and amortization. We would take this total and just use it for our next step. $5,320,000 plus $130,000 equals $5,450,000 right here. Then we go ahead to step number 3, which is changes in working capital. We would take again this totaling amount and move it here, and just take changes in working capital, which would, from our problem here, is 100,000. Take 5,450,000 minus 100,000, which equals 5,350,000. Then our fourth step is to subtract capital expenditure. And we would take this total amount and subtracted capital expenditure, which is $1 million. $5,350,000 minus $1 million equals $4,350,000. And that would be our free cash flow, $4,350,000.